right, folks, now that we've come to the end of the Q1 period here in 2026, thought it'd be a good idea to kind of just take a look at the national housing numbers, the data, see kind of where we stand, and see, how things are kind of doing. Just kind of take a pulse of the whole situation. Was the housing market, if you look closely at this data, it actually was starting to improve in early 2026. But now the trend might be starting to reverse, but it was looking good there for a while. Um, if you take a step back and kind of see where we stand nationally, now keep in mind, these are national numbers. I always say real estate, very localized. So when we look at numbers nationally, we have to take that with a grain of salt, that we're looking at the entire snapshot of the United States. We're not drilling down into local areas, cities, neighborhoods, etc. All right, now I'm pulling this data from Realtor.com, the National Association of Realtors, Freddie Mac, ATTOM, that's ATTOM data, and even the Wall Street Journal. And just throw this out there that most of this data is measured year over year, meaning we're comparing where we are today, right now, versus the exact same time last year. So April 1st of 2025 through right now. We're going year over year. So we get a clearer picture. I don't like to do as much weekly and monthly because I think real estate's one of those slower moving things as far as a market is concerned. So I find year over year data to be that much more beneficial to kind of get a pulse of what's going on. You can sometimes go 6 months out, but for the sake of this, we'll go a year. All right. I think a pretty clear picture starts to emerge. And what I want to start with is inventory. All right. Inventory is rising. No question about it. Inventory is going up. Realtor.com data shows that. Inventory is up 7 to 10% compared to a year ago. But I'm going to throw that out with the caveat that we're still well below the pre-COVID levels. So pre-pandemic, we had way more inventory. We have yet to get back to a number anywhere close to that. And there's still an estimated shortage of homes. I mean, we're still short. We've been talking about this forever. They just can't catch up. We're still short by 4 million homes nationally. That's right. We still need new construction, or we still need homes to go on the market, one or the other. So while you do have more homes hitting the market, and the data shows it, we're still well undersupplied if you compare it to historical numbers. All right, what else? Prices. Prices are definitely softening. And if you look at the median listing price, okay, so what a seller is asking, okay, the asking price, listing price, and you compare that year over year, we're actually down to about 2.4% compared to this time last year. So there's some definite downward pressure, I think, for sellers. And that's really the first shift we've seen in a while, where pricing power isn't as strong as it used to be. Sellers are having to list a bit lower than just a year ago. All right, what else? This is really interesting to me. So wages, okay, income versus housing affordability. So year over year data. This is from ATTOM, ATTOM, plus Realtor.com as well. This is an interesting trend that I don't think gets talked about enough. According to ATTOM data and Realtor.com, wages are actually starting to outpace home prices in about 64% of countries compared to a year ago. Okay, that's a pretty big deal. So you're finally starting to see wages sort of catch up and in some cases outpace home prices. So affordability is naturally going to get better if people are making more money, right? Income is improving while prices stabilize. And where are we seeing this? Well, some major areas like Los Angeles, Chicago, Houston, Phoenix, and San Diego. Some of these markets, home prices are slightly declining while wages are still going up in the 3 to 4% range. So you have prices declining, folks' wages going up 3 to 4% a year or so. And it's creating a lot more balance. But again, even with that, 97% of markets are still considered less affordable than historically speaking. So it's like we're seeing this little bit of improvement, but we're not really great. We're not that well off compared to historically how we've always been. Places like Los Angeles, it can still take over 60% of your income just to afford a home there. So don't get the wrong idea. Just because it's improving doesn't mean it got way better. So yeah, I mean, a little better, but how should I put it? Historically strained still. All right, what else? Okay, homes are taking a lot longer to sell. That is definitely a new trend. Again, year-over-year trend. We're seeing roughly 55 to 80 days on the market is about about how long homes are staying on the market. And that is longer than we saw a year ago. That is actually pretty, I don't want to say significantly, but it's longer. So buyers are slowing down and they're getting more selective. And that's what that means, right? So it's a bit of a shift. And to me, that is a major shift. We're seeing sort of this, fast moving market, that we used to have a couple of years ago, and it slowed down quite a bit. All right. So sales are still weak. That's for sure. Nothing changed there, monthly, annualized, no matter how you look at it. This is from the National Association of Realtors. Sales are still relatively weak. According to the NAR, National Association of Realtors, existing home sales are running at about 4.09 million annual pace. Now that's monthly data, but they do it as an annualized number. But again, that number, like historically low levels. So what does that mean? There's just not a lot of transactions going on. Just not a lot of sales. It's just kind of just a slow market, not a lot of sales. Not a lot of pending, not a lot of sales, not a lot of transactions, right? So, yeah, I mean, we've had a slight rebound here in the first quarter, but we're far from fully recovered. Stabilizing, but not strong. All right, let's look at rates. That's the biggest driver right now. All right, mortgage rates. That's why I cover it so much on the show. Rates dipped earlier this year to around 6%. I talked about this before. We were seeing people get as low as 5.99% for a 30-year fixed. And but recently, I covered this before the Wall Street Journal. They're telling us we're at 6.56% right now, and that is all tied to what I've discussed with inflation, oil prices, and what the Federal Reserve may do next. And you can catch that in the last show. In fact, I covered that. But there's a lot of risk there. Okay, so the market was actually, if you look at Q1 as a whole, and you compare Q1 to a year ago, you would have thought we're actually doing okay. Like things look like they're stabilizing, getting a little bit better. Yeah, transactions are still really low though. But affordability was improving a little bit. But you had higher inventory, you had prices softening. I would actually say you were in the early stages of a recovery, if anything. A very fragile recovery at this point. And I think you were shifting into more of a buyer's type of market, definitely more a buyer market than a seller market, at least nationally speaking. But again, I call it fragile because mortgage rates are rising again. And all this data was kind of based on 6% interest rates. And we've seen that in the last couple of weeks, it's shot up to 6.5%. So all of that improvement can just start to go away. And it's already starting. I think buyers are already starting to hesitate and they're getting a little nervous, and deals will start to fall through, and affordability will become a bigger challenge. And you've got a market right now that's just continues to be, and it has been for many years now, just extremely sensitive to interest rates. And it's just, that's the way it is. So we'll see, if rates continue to rise, yeah, it'll be a problem. Buyers will start to pull back. Demand will slow. No question, it'll slow down an already struggling market. But I think we can get back to the progress we were making earlier in Q1 if rates start to fall, if demand comes back and the market stabilizes. We'll see. I'm not going to get into what may or may not happen. Obviously, we know the cause of it. We got to see inflation come down. We got to see oil prices relax. And then we can maybe start to see where this goes. But hey, we're not going to know until it plays out. So we got a housing market starting to recover in Q1, but with rates rising again, well, let's just say the next move is far from certain. That is it for me today. Thank you so much for listening to today's show. And as always, if you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at the Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time.